Well, today it is all about the central bank on Capitol Hill. The current and former chairman of the Federal Reserve will defend the central bank's role as a financial supervisor. At the House Financial Services Committee hearing, Bernanke will argue the Fed is uniquely suited to monitor large and complex financial organizations. In a prepared statement, Bernanke will say, quote, "No other agency can or is likely to be able to replicate the breadth and depth of relevant expertise that the Federal Reserve brings to the supervision of large, complex banking organizations and the identification and analysis of systemic risks." So we're going to hear that from Bernanke a little later on today. Mr. Bernanke will also argue against legislation proposed by Senator Chris Dodd this week to limit the Fed's oversight over smaller community banks while increasing its power to regulate larger firms. Now, former Fed Chairman Paul Volcker, who you see on your screen now, will also be speaking at today's hearing. He's going to argue that the fragmented nature of the U.S. regulatory system contributed to the financial crisis. Let's talk a little bit more about this. Doug Flynn of Flynn Zito Capital Management joins us right now. So do you agree with Bernanke that the Fed is uniquely positioned to be the proper regulator of this financial system?
Not necessarily. I think that you have a lot of regulation already, and a lot of it was just not followed. So in some cases you had overregulation, some cases you had the right regulation, and some you had completely misapplied regulation. I think that's what contributed to a lot of this. I don't think we need more regulation from a different place. I think you just need to follow more what you have.
So what Senator Dodd proposed is that the Fed is going to get oversight of some of these more medium and larger firms, but as we mentioned, the community banks, the smaller banks, looks like they're going to be overseen by the FDIC, for example. What do you think of that model?
I think that the systems that are in place, if they are followed, I think they're better off. I'm not a big fan of layering on top, more managers on top of managers. You're managing the managers. Do we really need that? I think that you have a lot of systems already in place. You could argue that there's no doubt that they didn't work.
Right.
But I think a lot of it has to do with the fact that it wasn't set up properly. So I think reorganization, not additional management, is probably proper.
So there are some comments. Of course, the Fed was a big story yesterday, talking about the economy, talking about what we might be seeing out there as far as a recovery. Just your thoughts overall on how the Fed is talking about the economy. Do they have the correct assessment of what's going on out there?
I think so. I think that my bigger concern is about when they're going to raise interest rates. Are they going to wait too long?
Joe Brusuelas, by the way, an economist, says it's going to happen in our lifetime. It's just not going to happen this year. Do you agree with that?
Yeah, I think we were originally thinking it was going to happen towards the end of the year, but it could push off to next year. To do it right, you have to do it a little early. They're not going to want to do it a little early because of the pain that's going to inflict in certain areas like the housing market and increase in interest rates. But if inflation takes hold, you're going to have to raise it. And our bigger concern is if you wait too long, you're going to have to do a much larger rate increase next year. So we'd like to see a little bit at the right time. We're hoping that they do it the right way. You just don't know exactly when, but they're saying the right things, I think, at this point.
Well, then you could have the introduction as well of the so-called Volcker rule. We're supposed to hear a little bit more about that today. Do you think that would change anything? Would that change the momentum of a recovery if the financial industry has a restriction like that one?
I think it could. I think that there's definitely an impact. We have so much regulation in our industry. It's unbelievable.
But it didn't work.
There's no doubt about it.
I mean, this first go-around, and some were worried we're going to get a second round of this crisis.
Well, and you can argue with Madoff and all the systems that are in place that didn't work. You can argue with anything that there's tons of regulation on. Do you want to, just because it didn't work, what you have on the books, if it were followed, would it have worked? Maybe.
There's a lot of maybes, though.
There are a lot of maybes.
And it seems like, politicians as well as consumers want something that's a little bit more sure. Because, if you speed and you get caught, there's a consequence.
No doubt about it.
But it doesn't seem like there's the same sort of consequence here in the financial industry.
In our industry, in particular, we used to be able to advise clients on their 401ks. A couple of years ago, the rules changed, and now we're not allowed to. It's completely ridiculous. You have a system in place where there are advisors like myself and others who are CFPs who are fiduciaries. If you're an RIA, you're a fiduciary. You have that system in place. You could use fiduciaries. Everyone assumes their advisor is a fiduciary.
Sure.
They aren't. But you just need to clarify those rules. And those systems are already in place. You just need to say, let's use the fiduciary to do that, and you solve all your problems. You don't need a new regulation to tell you to do that.
It seems like making more things more complicated than they need to be. All right, Doug, thank you very much. Doug's going to be with us throughout the morning. In the meantime, Ashley, back over to you.